Late last night, a single policy announcement emerged from Washington. Not a tweet, not a press conference, but a structured financing initiative. Strategic minerals, industrial stockpiles, billions in committed capital. The words silver weren't in the headline. But here's what nobody's discussing yet. Silver was already classified as strategic 2 years ago. And if the United States government decides it needs a 60-day emergency supply, we are talking about procurement volumes that exceed the entire annual output of the world's fourth largest producing nation. The question isn't whether this matters. The question is whether you'll understand the implications before the market does. Welcome to Silver Radar. Now, if you've made it this far, you're clearly someone who values substance over noise, the kind of thinker who understands that real wealth is built on information, not impulse. So let me ask you something the way I'd ask a trusted colleague over coffee. If you're finding value in this analysis, would you consider subscribing? Not because we need the numbers, but because serious economic discussion deserves a serious audience. And while you're here, drop a comment and let us know where in the world are you watching from today? New York, London, Mumbai, Singapore? We're building a global community of strategic thinkers, and your perspective matters. Now let's get into what this announcement actually means. On the evening of February 3rd, 2026, a policy document circulated through Washington that most Americans will never read. No dramatic Oval Office address, no primetime announcement, just a detailed memorandum outlining a new strategic mineral stockpile initiative backed by billions in federal financing and structured private capital partnerships. The language was bureaucratic. The implications were not. Within hours, silver futures contracts began moving in ways that suggested someone somewhere had already done the math. Not panic buying, not speculative frenzy, just steady, deliberate accumulation by entities that don't typically announce their positions until the trade is complete. Because here's what the headline didn't say. Silver sits at the center of a technological dependency that most policymakers are only now beginning to understand. It's not just a precious metal anymore. It's the conductive backbone of solar panels, the antimicrobial layer in medical devices, the soldering material inside every smartphone, every electric vehicle, control system, every military-grade sensor array. When the document references minerals critical to American industrial competitiveness, it doesn't need to name silver explicitly. The inclusion is structural, unavoidable, and that creates a problem or an opportunity depending on which side of the market you're positioned. Let's establish the framework clearly. A strategic stockpile in U.S. policy terms is not a speculative asset play. It's a supply chain insurance policy. The Strategic Petroleum Reserve wasn't created to profit from oil price swings. It was designed to prevent economic paralysis during supply disruptions. The National Defense Stockpile operates on the same principle. Maintain a buffer of materials that cannot be quickly replaced if foreign supply chains collapse. This new initiative follows the same logic, but with a modern twist. The financing structure pairs government seed capital with private investment vehicles. Translation: this isn't just federal procurement. It's a public-private mechanism designed to move quickly past traditional bureaucratic delays and operate with the flexibility of a commercial entity while serving a strategic and national purpose. The target, a 60-day emergency supply of critical minerals for American industry. 60 days doesn't sound like much, but when you apply that metric to silver consumption rates, the numbers become significant very quickly. The United States industrial sector consumes approximately 180 to 200 million ounces of silver annually. Medical applications, electronics manufacturing, solar panel production, automotive systems, all of it requires continuous supply. A 60-day buffer represents roughly 30 to 35 million ounces. To put that in perspective, that's more silver than is produced annually by Poland, the world's 9th largest mining nation. It's approximately 4% of total global annual mine supply. And it would need to be procured, stored, and rotated through industrial supply chains without triggering the kind of price spiral that defeats the purpose of the reserve in the first place. But here's where the story gets more complex. Silver already carries a strategic designation in multiple U.S. policy frameworks. The Energy Act of 2020 classified it as critical to renewable energy infrastructure. Defense procurement guidelines recognize its irreplaceable role in military electronics. The Commerce Department, the supply chain vulnerability assessments have repeatedly flagged silver import dependency as a national security concern. So when this new stockpile initiative emerges, the question isn't whether silver qualifies for inclusion. The question is whether procurement has already begun quietly through mechanisms that won't show up in public data for months. Markets don't move on policy announcements alone. They move on positioned capital on informed entities making calculated bets based on information asymmetry. And the price action in silver futures, immediately following this announcement, suggests that certain participants understood the implications before the wider market did. This isn't speculation, it's pattern recognition. Every major government commodity intervention in modern history has followed a predictable sequence. Policy signal quiet accumulation, public confirmation, market repricing. The gap between the first and final stages, that's where strategic advantages are won or lost. Right now, we're somewhere between the first and second phase. The document is public, the financing structure is outlined, the procurement authority exists. What remains uncertain is the timeline, the volume, and the method. But make no mistake, if the United States government decides it needs a strategic silver reserve, the market will find out. The only question is whether you'll recognize it while there's still time to act. The global silver market operates on a fundamental vulnerability that most analysts overlook until it becomes critical. Every year, approximately 830 million ounces of silver are pulled from the earth through mining operations scattered across dozens of countries. On the surface, this appears to be a robust and diversified supply chain. The reality is far more fragile than the aggregate numbers suggest. Here is the structural weakness that changes everything. Only 25% of global silver production comes from mines where silver is the primary target. The remaining 75% emerges as a byproduct of operations focused on extracting zinc, lead, copper, and gold. This means that 3/4 of the world's silver supply is determined not by silver prices or silver demand, but by the economics of entirely different metals. When a copper mine in Chile calculates profitability, it factors in copper prices, copper demand, and copper costs. The silver that comes along is secondary, almost incidental. This creates a supply curve that cannot respond to silver-specific demand shocks the way traditional commodity markets do. Geographic concentration compounds this inflexibility. Mexico alone accounts for 23% of global silver production, making it the single largest source. China controls 13%, despite being the world's largest consumer, which creates a net import dependency for Chinese industry. Peru contributes 12%, and Chile adds another 8%. When you map these 4 countries, you are looking at more than half of global supply originating from regions with varying degrees of political stability, regulatory uncertainty, and infrastructure constraints. Now consider what happens when you layer a strategic stockpile program onto this supply structure. The United States currently produces approximately 30 million ounces of silver annually from domestic mining operations. American industrial consumption, however, sits between 180 and 200 million ounces per year. That gap, the difference between 30 million and 200 million, is filled entirely through imports. This 85% import dependency is precisely what strategic reserve programs are designed to address, but addressing it requires procurement, and procurement requires supply. If the U.S. government decides to build a 60-day emergency buffer, it needs to acquire 30 to 35 million ounces. That volume equals the entire annual domestic production of the United States. It represents roughly 4% of total global mine supply, and it must be purchased from a market where supply cannot quickly expand, because most silver production is a byproduct of other mining decisions. A zinc mine operator in Australia is not going to accelerate production because silver prices rise. The decision matrix is driven by zinc economics, and the silver simply follows. The inventory picture adds another layer of constraint. Total above-ground silver inventory, including industrial stockpiles, investment holdings, and jewelry, is estimated at 2 to 3 billion ounces accumulated over decades. However, the portion of that inventory that is liquid, meaning readily available for sale at prevailing market prices, is substantially smaller. Investment-grade silver held in vaults, exchange-traded funds, and allocated accounts probably represents less than 1 billion ounces. COMEX warehouse stocks, which serve as a key indicator of immediately deliverable supply, have been declining for several years. At the end of 2025, registered COMEX silver inventories stood at historically low levels relative to open interest in futures contracts. China presents its own complicating factor. As the world's largest silver consumer and a major producer, China has been systematically accumulating silver through channels that do not appear in official reserve reporting. Import data from Hong Kong, London, and Switzerland reveals consistent flows into Chinese refineries and vaults. While Beijing does not publish strategic silver reserve figures the way it periodically discloses gold holdings, the volume and consistency of these imports suggest deliberate accumulation rather than immediate industrial consumption. If a U.S. strategic reserve program triggers competitive stockpiling by China, the available supply shrinks further. Recycling cannot fill the gap. Current silver recycling recovers approximately 15% of annual supply, primarily from photographic waste, electronic scrap, and jewelry. Increasing that percentage requires higher prices to make recovery economically viable, better collection infrastructure, and time. Even under optimized conditions, recycled silver cannot replace mined supply at the scale required to meet both existing industrial demand and new government procurement. The mathematics becomes stark when you model government buying against supply constraints. If procurement occurs over 2 years, that is 15 to 17 million ounces annually. If the timeline compresses to 1 year, the full 35 million ounces must be sourced within 12 months. Either scenario represents a material demand increase in a market where supply growth takes 7 to 10 years. New primary silver mines require exploration, permitting, financing, construction, and ramp-up. Byproduct silver supply depends on base metal mine economics that are independent of silver pricing. This is not theoretical scarcity. This is arithmetic applied to a commodity with inelastic supply facing a new category of non-discretionary demand. Industrial users cannot stop buying silver without shutting down production lines. Investment buyers can choose to sell, but only at prices that compensate for opportunity cost and future replacement risk. And if a government buyer enters with a strategic mandate and public financing, that buyer is not price sensitive in the way commercial market participants are. Strategic reserves are built regardless of cost because the alternative, supply disruption during a crisis, carries consequences that far exceed procurement expenses. The supply chain mathematics point to a single conclusion. If this stockpile initiative moves from policy document to active procurement, the silver market lacks the structural flexibility to absorb that demand without significant price adjustment. The only variables are timing and magnitude. Everything else is already determined by geology, geography, and the fixed realities of mining economics. Every government intervention in commodity markets follows a predictable sequence, and the patterns are consistent enough to serve as a roadmap for what comes next. The Strategic Petroleum Reserve offers the clearest modern precedent. When Congress authorized its creation in 1975, following the oil embargo crisis, the stated objective was straightforward: establish a buffer stock of crude oil to prevent economic paralysis during future supply disruptions. What followed was 2 decades of systematic government buying that fundamentally altered how oil markets priced risk, liquidity, and geopolitical uncertainty. The mechanics were simple but profound. The U.S. government became a persistent buyer in a market where it had previously been absent. Not a speculative buyer responding to price signals, but a strategic buyer with mandated volume targets and congressional funding. This introduced a new category of demand that did not disappear when prices rose and did not diminish when inventories appeared adequate. Markets adapted by repricing the entire forward curve to reflect this permanent demand component. Oil producers factored government purchases into their development decisions. Traders built the reserve program into their basis calculations. The mere existence of strategic buying changed the equilibrium price, independent of whether the reserve was ever actually used. The National Defense Stockpile demonstrates a parallel dynamic with industrial metals. Established in 1939 and expanded dramatically during the Cold War, the stockpile accumulated manganese, chromium, tungsten, cobalt, and dozens of other materials deemed critical to military production. Government buyers entered markets that were previously driven purely by commercial demand. Procurement occurred regardless of price because the strategic calculus was binary. Either the material was available during a crisis or it was not. Profitability was irrelevant. Market timing was secondary. The mission was supply security, and that mission overrode every other consideration. Prices responded accordingly. When the government announced it needed 10,000 tons of cobalt, the market did not ask whether that demand was economically justified. It asked where that cobalt would come from, how quickly it needed to be delivered, and what other buyers would be displaced. The price discovery process shifted from marginal supply-demand balance to strategic competition for finite resources. Markets do not treat government buyers the same way they treat commercial buyers, because governments have different constraints, different time horizons, and fundamentally different tolerance for price volatility. Silver carries its own historical precedent that illuminates what may be coming. The Silver Purchase Act of 1934 authorized the U.S. Treasury to buy silver until it reached 1/4 of the monetary reserve base, or until silver hit $1.29 per ounce. Treasury became a relentless buyer, purchasing hundreds of millions of ounces over several years. The price impact was immediate and sustained. Silver markets repriced around the reality of a buyer with unlimited funding and a mandated target. When Treasury finally stopped buying in the early 1960s, the accumulated stockpile exceeded 2 billion ounces. The subsequent disposal of that stockpile during the 1970s and 80s had the opposite effect, depressing prices for years as government silver flooded the market. The pattern is instructive. Government accumulation creates sustained price pressure upward. Government disposal creates sustained price pressure downward. Both processes override normal market dynamics because the volumes involved are large relative to annual production, and the buyer or seller is not motivated by profit optimization. This is not a market participant trying to buy low and sell high. This is an entity executing policy regardless of market conditions. More recent examples confirm the pattern persists. When China announced its rare earth stockpiling initiative in 2010, prices for neodymium, dysprosium, and other elements critical to technology manufacturing increased by 300 to 500% over the following 18 months. The actual volume of government procurement was never disclosed, and in retrospect, the physical buying was probably modest compared to industrial demand. But the signal that China intended to control rare earth supply chains was enough to trigger speculative positioning, industrial panic hedging, and a complete repricing of the market. The announcement mattered more than the execution. Markets moved on the information asymmetry, on the recognition that some participants understood the strategic shift before others did. By the time rare earth prices peaked in 2011, the window for advantageous positioning had already closed. Those who recognized the pattern early captured the repricing. Those who waited for confirmation watched from the sidelines as prices reached levels that seemed irrational until they were simply the new reality. Silver markets today sit in a comparable information environment. A policy document has emerged outlining a strategic mineral stockpile with financing mechanisms and procurement authority. The document does not specify silver explicitly, but silver's inclusion is structurally implied by its designation as a critical material in multiple existing policy frameworks. Markets are processing this information unevenly. Sophisticated institutional participants who monitor policy developments closely have likely already adjusted positioning. Retail investors who rely on headlines remain largely unaware. Industrial consumers who depend on silver supply are beginning to evaluate hedging strategies but have not yet moved aggressively. This dispersion of information creates the classic preconditions for a repricing event. Some market participants see what is coming and act accordingly. Others remain anchored to historical price ranges and demand patterns that may no longer apply. The gap between these two groups is where price discovery occurs, often rapidly and with significant volatility. Futures markets tend to move first because they offer leverage and liquidity. Physical markets follow as industrial buyers recognize that futures prices are not temporary anomalies, but signals of structural change. Investment demand compounds the move as both institutional and retail capital flows into assets perceived as benefiting from the new regime. The feedback loops become self-reinforcing. Rising prices validate early positioning, which attracts additional capital, which drives prices higher, which triggers stop losses and forced covering by short sellers, which accelerates the move further. By the time the repricing is complete, the market has established a new equilibrium that reflects the presence of a strategic buyer, the constraints of inelastic supply, and the repricing of risk across the entire forward curve. Participants who understood the pattern early benefit from the entire move. Those who wait for definitive confirmation enter after the primary repricing has already occurred. History does not repeat precisely, but the structural dynamics are remarkably consistent. Government commodity interventions introduce demand that is large relative to supply, persistent rather than cyclical, and strategically motivated rather than profit-driven. Markets respond by repricing to reflect this new reality. The time between policy signal and full repricing varies, but the pattern itself is predictable. What remains uncertain is where we are in that sequence right now. Has strategic silver procurement already begun quietly, or are we still in the policy announcement phase before actual buying commences? The answer determines whether the window for advantageous positioning is still open or has already closed. The silver market now stands at an inflection point where three distinct pathways diverge, and the path taken will determine outcomes for industrial consumers, investors, and policymakers over the next several years. Understanding these scenarios requires moving beyond speculation and into probability-weighted strategic assessment. Each pathway carries different implications for price discovery, supply chain stability, and capital allocation decisions that serious market participants must evaluate now, not after the outcome becomes obvious. Scenario 1 assumes the stockpile announcement represents political signaling rather than operational commitment. In this pathway, the policy document circulates, generates temporary attention, and then stalls in the implementation phase due to budget constraints, bureaucratic resistance, or shifting political priorities. Appropriations committees debate funding levels. Agency jurisdictions overlap and create coordination delays. Private capital partners prove difficult to structure or negotiate terms that satisfy both commercial return requirements and strategic objectives. Months pass, then quarters, and eventually the initiative fades into the background noise of government programs that never fully materialize. Markets initially respond to the announcement with modest positioning, but as implementation delays become apparent, prices retreat toward historical ranges. Industrial buyers who hedged aggressively find themselves overpositioned. Speculative capital exits. The opportunity cost of early positioning turns negative, and the strategic reserve concept is filed away as another policy proposal that failed to execute. Scenario 2 envisions gradual, methodical accumulation over an extended timeline. In this pathway, the stockpile program receives funding and begins procurement, but the approach is deliberately paced to avoid market disruption. Government buyers coordinate with the largest industrial consumers to understand supply chain flows and identify procurement windows that minimize price impact. Purchases occur opportunistically when market conditions allow, spread across multiple years, and structured through private partnerships that provide flexibility. Annual buying might average 5 to 10 million ounces. material enough to influence the market but not overwhelming relative to total supply. Prices rise steadily as the market adjusts to this new permanent demand component, but the increase is measured rather than explosive. Industrial supply chains adapt gradually. Mining companies respond with capacity expansions that take years but eventually increase primary silver production. Recycling rates improve as higher prices make recovery economically attractive. Investment demand increases but remains proportional to industrial fundamentals rather than speculative excess. This scenario represents managed transition rather than crisis repricing. Scenario 3 is the disruptive pathway, where strategic imperatives override market considerations. In this version, geopolitical developments or supply chain crises create urgency that eliminates the luxury of gradual accumulation. Perhaps tensions with China escalate, and policymakers conclude that dependence on imported silver represents an unacceptable vulnerability. Perhaps a major industrial disruption, a solar manufacturing crisis, or defense procurement emergency demonstrates that existing just-in-time supply chains cannot handle stress. Whatever the trigger, the response is aggressive procurement with compressed timelines. The government needs 35 million ounces and needs them within 12 to 18 months rather than spread over 5 years. This volume hits a market where supply is already constrained and cannot respond quickly. Prices spike as buyers compete for limited deliverable inventory. COMEX warehouse stocks drain rapidly. Physical premiums over futures prices expand to unprecedented levels. Industrial consumers who lack adequate hedges face input cost shocks that force production cuts or financial losses. Speculative capital floods into silver, amplifying the move. Exchange-traded funds see massive inflows. Retail investors, watching prices climb week after week, pile in based purely on momentum. The feedback loops become self-reinforcing, and the market temporarily loses rational price discovery as fear of shortages and fear of missing gains both drive buying. China's response in Scenario 3 determines whether the disruption remains contained or escalates into genuine crisis. If Beijing interprets U.S. stockpile building as the opening move in resource competition, Chinese strategic reserves accelerate their own silver accumulation. With China representing both the largest production base and the largest consumption market, aggressive Chinese buying removes supply that would otherwise be available to global markets. The competition between the world's two largest economies for the same finite commodity resource creates a bidding war that sends prices to levels that would have seemed absurd under normal market conditions. Industrial applications that can substitute away from silver begin to do so, but substitution takes time and often involves performance trade-offs or higher costs. Applications where silver is technically irreplaceable, certain medical devices, high reliability military electronics, specialized sensors, face genuine shortages. Waiting lists develop for deliverable metal. Refineries and mints operate at capacity but cannot meet demand. The market fractures into tiers based on access and relationships rather than transparent price discovery. History suggests Scenario 3, while extreme, is not implausible. Commodity markets have experienced comparable dislocations when supply constraints met surging demand. Oil in the 1970s, palladium in the early 2000s, lithium in recent years, all demonstrated how quickly markets can move from apparent stability to genuine shortage when structural imbalances meet catalysts. Silver carries additional volatility risk because its small market size relative to gold or oil means that large capital flows create disproportionate price impacts. The entire annual global silver market at current prices represents roughly $25 billion. For comparison, that is less than the market capitalization of many individual technology companies. When capital wants exposure to a strategic commodity thesis, relatively modest institutional flows can overwhelm available supply. Investment demand represents the wild card that could amplify any of these scenarios. Silver has a dual identity as both industrial input and monetary metal, and that duality means investment buyers respond differently than they would to purely industrial commodities. If strategic reserve announcements trigger renewed interest in silver as a wealth preservation asset, investment demand could match or exceed industrial demand. Exchange-traded funds hold approximately 600 million ounces currently. If those holdings increase by 20 or 30% due to strategic commodity positioning by pension funds, sovereign wealth funds, and family offices, that represents an additional 100 to 200 million ounces of demand. That volume exceeds any realistic government procurement target and would occur simultaneously with that procurement, compounding the supply pressure. The strategic assessment for decision makers across different sectors depends on which scenario seems most probable and what the cost of being wrong might be. Industrial consumers face a classic hedging dilemma. Hedging aggressively in Scenario 1 results in wasted capital and opportunity costs. Failing to hedge adequately in Scenario 3 results in input shortages or catastrophic cost increases. The optimal strategy depends on probability weighting and risk tolerance. Investors face a different calculation. Early positioning captures the full repricing. if scenarios 2 or 3 materialize, but risks capital stagnation if scenario 1 plays out. The opportunity cost of waiting is missing the repricing entirely. The cost of acting prematurely is holding positions that generate no return for extended periods. What cannot be disputed is that the information environment has changed. A policy framework now exists that did not exist previously. Financing mechanisms are outlined. Procurement authority is established. Whether that framework translates into material market impact depends on execution, but the probability distribution has shifted. Markets that previously priced silver purely on industrial supply-demand fundamentals must now incorporate strategic reserve risk into their models. That incorporation occurs gradually as different participants update their assumptions at different speeds. The participants who recognize the shift earliest and adjust positioning accordingly capture the information advantage. Those who wait for definitive proof act after the market has already repriced to reflect new realities. The final question is not whether this matters. The mathematics of supply constraints meeting potential government demand make it clear that material price impacts are possible under certain execution scenarios. The question is whether the strategic shift is already underway and simply not yet visible in public data, or whether we remain in the policy discussion phase before actual procurement begins. Every week that passes provides additional data points: futures positioning, physical premiums, ETF flows, mining company guidance, industrial hedging activity, all contain signals for those paying attention. The crossroads is here. The pathway chosen will become clear eventually, but eventually is too late for strategic positioning. The decisions that matter are made now, when uncertainty is highest and the crowd remains unaware. That uncomfortable space between signal and confirmation is where strategic advantages are built or squandered. History is consistent on this point. The market rewards those who see the pattern forming, not those who wait until the pattern is obvious.